Hello legends, it's Guan here. Good to see all of you here today. Thanks for tuning in for today's video. Now, Cathie Wood's ARK Invest ETF have almost sold all of the Chinese stock positions, such as the likes of Alibaba, Tencent, JD, Pinduoduo and more. As a result, her ETF portfolio currently holds these Chinese stocks at an average of 0.5% of the ETF portfolio holding. Surely the negative news about CCP crackdown definitely has been the major catalyst in this sell-off. Coupled with this big name fund manager doing the same thing, it's definitely hard for investors to see the road ahead. So in this video, I'll look into the fundamental philosophy of big asset funds and why I think investors should take big fund moves like this with a grain of salt. And finally, my Alibaba DCF valuations. Big funds like ARK Invest primarily make money via the management fees, often known as the expense ratio fees. This is the most basic thing that one has to understand. Now, the ARK Invest ETF managed to hit a massive return in the recent years due to the Tesla 600% share price gain. And this attracted a lot of eyeballs from investors. So, now there are a lot of people chipping money into the ETF, just like people queuing before the Black Friday sale. And this just means more management fee for ARK Invest. Now, the hard part here is that ARK Invest has to continuously generate moonshot-like Tesla investment returns in order to attract more investors, and therefore more management fees. Case in point, after the 2020 rally, ARK Invest ETF total assets under management went from $3.2 billion in 2020 to $34 billion in 2021, and that attracted $1.2 billion into the fund, placing it top 4 in terms of net inflows of capital comparing with other ETFs. Hypothetically, if ARK Invest is holding a 10% portfolio holding of Alibaba, what do you think the retail investors would think of an ETF? What the? This would definitely trigger a lot of sell-off and redemption from a fund, as people would think that her ETF sucks big time.
Well, this sucks.
Now you see the problem of big name funds, where they have to consistently outperform every week, every month, every year, by a huge margin in order to attract more money so as to earn more management fees. So that being said, the fund has to shut off bad stock performance in terms of share prices, so that the fund will look shiny to the investors. Just like when you're given a choice to buy either a beautiful donut or an ugly donut, and the donut filling is the same for both. You probably feel okay to pay a premium to buy the beautiful donut, don't you? The conclusion here is that people have shiny object syndrome, and investors always need to take moves like this with a grain of salt. Don't overdose with salt like Salt Bae. Now, do you agree with my findings? Be sure to like, sub, click the bell. Don't forget to comment down your thoughts. The Alibaba DCF valuation. Given that the massive Alibaba stock sell-off is driven by the market sentiment, not by the business fundamentals, investors will definitely need to stay level-headed in events like this. I have previously performed a sum of parts valuation in my previous Alibaba video. You can find the link up here or in the description down below. And for this time, I chose to use DCF to value Alibaba as a whole, with bear and bull cases. Welcome to my Alibaba DCF valuation model. So a bit of caveat here. Everything here will be quoted in terms of USD millions, except any per share data. So over here in this valuation model, I have the bear case as well as the bull case scenario over here. So let us just take a look at the bear case scenario first. Right. So a bit of an overview. I have the historical section over here on the left hand side, and I also have the forecast years on the right hand side. So on the historical year section, I have the revenue growth data, and also the EBIT, EBITDA, to free cash flow percentage of EBITDA, and so on. And of course, I have the free cash flow yield calculated down here. As you can see, it's showing the numbers between 4%, 3.8%, 3.6% of free cash flow yield. So now let's just move on to the assumptions table. So in this bear case scenario, I'm estimating a revenue growth of just 15% and soon to be dropped to just shy of 10%. And in my case, in the terminal year free cash flow multiple, I am actually assuming that given that this is a Chinese firm, this Chinese company, I believe that the market is unwilling to give it a higher premium as compared to the other Western big tech counterparts such as Amazon, Google, Facebook, and so on. So that being said, the discount rate, I'm also giving it a higher than usual discount rate as compared to other companies. Similar reason to the terminal year free cash flow multiple, right? Because after all, it's still a Chinese company. With all that being said, the total intrinsic value estimated to be just shy of $1 trillion. And now with a current market cap of about just shy of $500 billion, this will then give us a potential upside of about 104%. And translating that data to the theoretical intrinsic value per share, this will then give us about $359 per share. Comparing with the current market price of $161 per share, this is definitely an attractive one. On the right hand side, I have the IRR calculation right here. So let's just assume that if you were to buy in this one Alibaba share at the price of $161 per share, and assuming that you can sell this share at a theoretical intrinsic value of about $360 per share, you would then be able to get a hypothetical IRR of 31%. In the context of comparison, the IRR of 31% versus that of the S&P 500 annual return, which is standing at about 6 to 8%. I think definitely this seems to be a very, very attractive return. So now here's the turn for the bull case scenario. So nevertheless, let's just go straight to the assumptions right here. So in these assumptions, I'm only just changed the revenue growth data from 30%, and I'm estimating that soon it will drop to just shy of 20% of revenue growth. And the EBITDA margin, the free cash flow to EBITDA margin all remains the same. And terminal year free cash flow multiple will remain the same as well at 20 times. And discount rate, I'm putting it at 15% as well. And so with that being said, the then total intrinsic value would then be estimated to be at the range of $1.5 trillion. And with the current market cap of about $478 billion, this then gives us a potential upside of about 225%. And translating that to the intrinsic value per share data, it would then give us a theoretical intrinsic value per share of about $573 per share. Comparing that with the current market price of about $161 US, I think that definitely gives us a relatively high upside, assuming if the bull case does come true. On the right hand side, I have the IRR calculation over here. So again, hypothetically, assuming that you buy the current Alibaba share at this price, and assuming that you can sell the Alibaba share at year 2025 with this theoretical intrinsic value achieved, IRR will be bumped up to 48%. Again, this is definitely a super lucrative return, assuming if it comes true, assuming that the revenue growth does come true, assuming that the margins and every other thing would remain at relatively the same rate. Assuming that the free cash flows in the forecast years, they all do come true, and this would then give us a potential free cash flow yield at the range of 6% to 13 to 14%. Okay, so this is the Alibaba relative comparable model, or also typically known as the relative comp model. And caveat here, everything will be expressed in terms of USD millions. Right? So in this relative comp model, I have the Amazon, Walmart, Google, and JD.com, which are typically the large e-commerce / internet services company. And from the left hand side to right hand side, I have the stock market data, I have the financial operations metrics, as well as the valuation ratios. So in terms of current market cap, they are all over here, and I'm using the latest data that can be acquired from Google Finance. Moving forward, let's just take a look at the valuation section right here. So the enterprise value is calculated by just taking a market cap plus the debt minus the cash equivalent. With that being calculated, the EV to EBIT is then calculated by just taking the enterprise value to divide with the operating income. And the same thing goes for the EV to free cash flow ratio. So with all that being calculated, there we have our average and also the median EV to EBIT, as well as the average and median EV to free cash flow ratio. So now with this calculated, so with all that being said, now let's just compare that with Alibaba Group, where you can see the EV to EBIT is calculated to be 31, whereas the EV to FCF or EV to free cash flow is calculated to be around 17 times. Now you can see right here that the EV to EBIT, they are just closely related to each other, which is not much of a difference in terms of the trading ratio. Whereas if you compare that with the EV to free cash flow ratio, you can see that Alibaba is significantly cheaper than the average as well as the median. So with all that being said, I believe that the Alibaba Group is currently trading at a super duper attractive valuation, especially compared that against with the peers such as the likes of Amazon, Walmart, Google, JD.com.
Do you agree with my findings? Let me know in the comments. Be sure to like, sub and click the bell for more videos every Friday. And I'll see you in the next one.